Today's video, we are talking about the difference between a charge card versus a credit card versus a debit card. So we're going to move quickly through this video and we're going to start with a general overview. When it comes to a credit card, it has a predetermined credit limit. And from the research I've done, that averages around $5,000 to $10,000 a month. And that's going to be determined by your credit worthiness. Now you can repay it within a month to avoid any interest penalties, but if you don't pay it off in your full month, you'll accrue interest charges every single month. Now with a charge card, this is essentially a premium credit card, but you also have a credit limit that is usually higher than a credit card. Some charge cards will approve larger purchases that go beyond your credit limit, and a balance is required to be paid back by month end, so there's no rolling payments. So credit card, you can roll over payments each month. You don't have to pay the entire lump sum of that month. A charge card, you do have to pay the entire amount that you spent that month at the end of the month. Now with a debit card, it's tied to a bank account, and essentially you're paying cash immediately from your available funds in your bank account, but it does carry some risk with it that we will get to in a little bit. So qualifications and reporting. Reporting meaning like reporting to consumer reporting agencies. Now, for a credit card, it requires a credit check, and this is for personal and business. It is available to people with a wide range of credit scores, and secured credit cards are available for people with no credit or bad credit. So that's why it allows a wide range. It will report to the credit reporting agencies and affect your credit score. So if you're good with your credit card, you can actually improve your credit score. If you're bad with your credit card, you will reduce your credit score. Now for a charge card, it also requires a credit check. It typically requires very good credit and a higher income level. So if you think of it in terms of like a normal credit card is available to anybody, a charge card is usually those premium cards that a lot of people think are credit cards, but are technically charge cards, and they have better rewards, they have higher limits, but it requires very good credit and a higher income level. They will report also to the credit reporting agencies and affect your credit score. Now for a debit card, a credit check is not required. I have read that in some rare cases, they will check to see if maybe you have an open bankruptcy or something like that, but I think that's rare. And then this does not report to the CRAs, also called credit reporting agencies. So if you're looking to build credit, a debit card is not the way to go. So an overview of cost. So with a credit card, the annual fee is typical. What I've found many times, it is waived the first year, and they average around $100 per year. It kind of depends on how good the rewards you're getting are on that credit card. Now, monthly interest fees average around 14 to 15% since early 2018. That is according to Experian. So if you have less credit, or you're not you don't have good credit worthiness, those fees will be higher. If you've had really good credit and you've had credit for a long time, those fees may be a little bit lower. Now with a charge card, the annual fees are typically around $110, but if you're getting some really good rewards, it's not uncommon to see those annual fees up into the $500 range. A lot of times that may be associated with a business that's spending a lot. There are no monthly interest fees in terms of APR, since full payment is required each month, but you are charged a late fee, typically of $30 to $40 each month that you're late, and you are charged interest on some of those payments. And the weird thing is that some do allow revolving payments with interest fees. Now the weird thing is that some do allow revolving payments with interest fees, which is very similar to just having a credit card. But typically, if you do not pay your charge card in full at the end of the month for several months, they're just going to close your account down on you, because that's not what they're looking to do with that particular product. Now with a debit card, all purchases are immediately deducted, and therefore there are no interest fees. But typically there are no annual fees as well, but there will be fees for overdraft or account management fees. So if you're setting this up with a bank account, just see what that bank account fees are month to month and what they're charging you there. Now for protections, this is where you'll see some big differences as well. A credit card is protected by the Truth in Lending Act, which covers fraudulent use. So this is for personal or business, and it has to cover up to $50 and $0 if it was online fraud. What that means is if your card was stolen, you might have to cover the first $50 in purchases, but if it turned out that was online fraud, you're not liable for anything. You don't have to even pay $1 back for fraudulent use. Now, it's also covered by the Credit Card Accountability, Responsibility, and Disclosure Act, which is also called the Card Act. Seems like somebody tried to, start with the acronym of CARD and then fit the words into that. So this protects consumers from interest rate hikes on existing balances, floating due dates, and double cycle billing. Essentially just kind of predatory practices that credit card companies may have been doing in the past. The Card Act protects you from that. It is required for personal, but has been voluntarily adopted for business credit cards. Pretty much all credit card companies go by the Card Act at this point. Now for a charge card, it is covered by both the Truth in Lending and the Card Act. Everything you see above, charge cards are covered with as well. But for a debit card, it is protected by the Electronic Funds Transfer Act, EFTA. Now, the way that this differs is if you do have fraud on your debit card, if you report within 2 days, your liability is limited to $50. If you report within 60 days, your liability is limited up to $500. And if you report after 60 days, you can risk unlimited losses. So for whatever reason, if you had a chunk of money that was fraudulently taken off of your bank account via your debit card and you don't catch it for 2 months, you could potentially lose all that money. One of the other issues here too is that the way that this works when you report losses on a debit card, the financial institution has up to 10 days to run essentially a report or investigate this. Then they have up to 3 days to refund you the money. And I think if they're wrong on their end or it was fraudulent, then they have 1 day to get you the money back. So it can take up to 2 weeks before you ever get that money back with a debit card. And typically it's much faster with a credit card where they can approve and see that it was a fraudulent purchase and be able to refund you much quicker. So this is a huge difference between these two. If you are comparing credit cards and charge cards versus a debit card, it is just kind of common practice, commonly known, that a debit card leaves a lot more liability on the table for you as a user. So now let's talk about rewards, which is the main purpose of this YouTube channel because we love talking about credit card rewards. With a credit card, there are hotel travel rewards, cash back, which is my preference, gift cards, gas cards. With a charge card, you have all of those things, but usually these rewards are even better, but it requires a higher credit and income to apply. So a lot of times you'll see these it's like the black card or the Amex Platinum card or those types of things. Those are actually charge cards with better rewards, but typically higher fees annually, but it requires that high income and credit to apply. As I mentioned, the annual fees will be larger for these cards to offset the higher rewards. Now with debit cards, typically there are no rewards offered. There are some online banks that offer rewards, but those rewards really pale in comparison to credit cards and charge cards. The reason for that is they're not making a lot of money off of late payment fees, so they don't have a lot of money to give back to you in the terms of rewards. When you're thinking about rewards, it really comes down to if you're a responsible consumer or if you're not a responsible consumer. Now, if you're getting a lot of rewards, but you're not a responsible consumer, it's kind of like being that person that goes to the casino and loses a ton of money, but brags about the rewards the casino is giving them. Like, oh, I got a free night stay or a free round of golf. Like, that's because you're giving the casino a lot of money. If you're somebody who's not responsible with a credit or charge card, you are really losing money, but it just looks fun because you're getting some rewards back, but you're paying for those rewards. So how do you decide what's right for you? Now, just to kind of do a quick recap, credit cards are good if you're responsible and want to take advantage of rewards. A charge card is good if you're a higher earner with good credit history. And a debit card is good if you're worried about overspending and not interested in rewards or building credit. In my opinion, it's great to start with a good credit card and then move your way up into a charge card. To finish this video, there is a difference between a secured credit card and an unsecured credit card, and this might be interesting to you if you're trying to decide on what credit card is the best for you. Many people will start with a credit card, and what we're going to be talking about in the next video is what the difference between a secured credit card and an unsecured credit card is so that you can get started and build credit. All right, I'll see you in the next video.